Fair value gaps are one of my favorite entry models in trading, and after taking thousands of trades at this point using the fair value gap, I'm going to expose all the secrets and gems that I have learned over my career to make you a better trader. But before we get into the video, make sure you guys are following me on Instagram at Arkhamtrades. Like, subscribe, and comment what you guys want to see next. But before I get into the secrets, I'm going to briefly explain what is a fair value gap and the three main use cases when it comes to trading fair value gaps. A fair value gap is a 3 candlestick formation. So as you can see on the left here, we have this bullish candlestick, this next bullish candlestick, and this third bullish candlestick. This middle area between this high of this wick and the low of this wick, this separation would then be classified as our bullish fair value gap. So as you can see here during this depiction, only buy side was offered, sell side was not offered. So the market is going to come back lower, offer that sell side to rebalance the marketplace before then seeing that continuation to the upside. Vice versa for a bearish fair value gap. So as you can see here, we've been making lower prices. The separation in this middle area from this high wick to this low wick, that separation here with this one body close, this would then be classified as our bearish fair value gap because only sell side was offered in this area. So the market has to come back higher, rebalance this level, offer that buy side before then seeing that continuation to the downside. And our first use case when trading fair value gaps is the continuation pattern. So as you can see in this depiction, we had this impulsive leg higher. We came back, retraced inside of this bullish fair value gap, gave that impulsive move higher, came back, retraced inside of this fair value gap, once again doing the same thing until we meet our level of targeting. So this would then be a continuation pattern. So fair value gaps are great entry criterias when anticipating a retracement coming into the marketplace for that continuation of trend or reaching up into an objective. Next is the reversal pattern. So as we can see here, the market reached up higher into this resistance level. After reaching up into this resistance level, we then see this shift lower. After that shift lower, that initial fair value gap here, this bearish fair value gap, this is then a high probability fair value gap. And then we see this break lower, retracement back into this bearish fair value gap, break lower, retracement, lower, retracement, all the way down into our level down here. So a fair value gap can either be a continuation pattern into our area of targeting or a reversal pattern after reaching up into an opposing level of either resistance or support. And last but not least, we have the draw on liquidity. When we have been making higher or lower prices consecutively, the market then becomes inefficient. This then creates an imbalance between buyers and sellers. So the market is going to retrace into these inefficient levels to rebalance before continuing its direction. For example, in this depiction, we've been making lower prices. We have this bearish fair value gap all the way up here. Let's say this is a 1 hour fair value gap. So the market right now is inefficient. We have this bearish level of inefficiency above us, and the marketplace wants to reach back up there to rebalance that level before continuing going lower. So in this use case, we can actually take longs at these lows after establishing a low, take longs inside of bullish fair value gaps until we reach up into that higher time frame bearish H1 fair value gap, rebalance that level before then shifting lower and reversing, now supporting bearish fair value gaps. So in this one depiction, we include all three use cases. We have the draw on liquidity. We've had this consecutive move lower, bearish fair value gap up here. We want to see the market reach up there. So that's our area of targeting. We can take the continuation fair value gaps in the uptrend until we reach up into that level, and then after reaching up into that level and we get that break lower, we can now take the reversal pattern in these bearish fair value gaps. Now that we have those three use cases out of the way, Our first secret is having the right narrative. One general rule that I have when trading fair value gaps after taking many losses is I will not take a fair value gap trade after price has already reached up into my level of targeting or is an opposing level on the higher time frames. So in this case here, we have these bullish fair value gaps below us. So you may be anticipating price action to come down into these bullish fair value gaps, find support to then continue going higher. This was a mistake that I made as well. Understand that after price action has just taken out liquidity, these bullish fair value gaps then lose probability, meaning if you're anticipating price action to hold inside of this bullish fair value gap, it's less likely of that happening after we've already met our targeting, meaning I would want to take this trade before it took out liquidity. The fact that it came up higher and already taken out liquidity invalidates this trade, and I will not take this trade idea inside of this bullish fair value gap because of this exact thing. And as you can see, the market completely reverses here. Price action has already came up and taken out this buy side liquidity pool. It's already came up, took out liquidity. So that means our target has already been met, meaning the likelihood of these bullish fair value gaps holding is less likely. So you guys have to be aware of where is the market reaching into. And if price has already met that area of targeting, that fair value gap is less likely to hold. And I'm going to show you guys an exact scenario that I took the other day that completely avoided a loss. So coming into the markets here, April 18th, I was with my live trading students. First link of the description is my Patreon. I'm live with my students every single morning. So we have this high of week here, which I told my students I wanted to see the market reach up into, and then we had this bullish fair value gap. I said if we reach up into this liquidity pool and we do not tap into this fair value gap before reaching up into this liquidity pool, I'm going to walk away because the likelihood of this fair value gap holding after it's taken out liquidity is less likely. And we can see exactly what happens next. Price action comes up higher, takes out that liquidity pool. I walk away. I'm done for the day. But let's say you were unaware of overall narrative and you see this bullish fair value gap, unaware that we've just taken out liquidity, and you try to go long inside this bullish fair value gap. Let's see what happens. You end up getting completely reversed on, right? This is why it's important to be aware of overall narrative. I said I want to see price action tap into this fair value gap before taking out that liquidity pool. It unfortunately didn't do so. Price action kind of just went higher. After it took out a lot of liquidity, I said I was done for the day and I walked away, completely avoiding this loss because of this one simple change. Our next secret is the 25% level. After taking thousands of FET trades, I've realized the 25% level of a fair value gap is the best entry to get into. Sometimes price may not reach up into the 50% level and you may miss that trade. Sometimes it may just tap into your opening of the fair value gap. But if you take it at the opening, it only opens you up to a lot more risk with a much bigger stop size, and who wants that? The 25% level is the best of both worlds when it comes to getting a great risk to reward as well as ensuring that your trade gets tagged. So for the most part, I want to enter my trades inside of this 25% level. So as we can see here in this depiction here, we have this bearish fair value gap. And this was actually a trade here that I took last week, April 12, 2024. So if we anchor our Fibonacci here, we want to then expose ourselves to the quadrants. We have the 75% level, 25% level, and the 50% level. I want to get into my trades at that 25% level. Not only does it ensure that my trade gets tagged a lot more than the 50% level, but it gives me a great risk to reward. And this is how I'm able to top tick a lot of great trades. So I'm going to put my risk to reward tool here at the 25% level. Stop loss above this high. Take profit down here for a 2-to-1 R. Very solid trade. Let's see how this then plays out. Price comes up to that 25% level to the tick before we then see that continuation to the downside. if we put it at the 50% level, it would have never got up here. Yeah, we could have gotten a great risk to reward, but it would have never tagged us into the trade. So you guys want to ensure that you guys actually get inside of these trades instead of trying to be ultra precise. Our third secret is the unicorn model is king. If you guys are unaware of the unicorn model, it's essentially a fair value gap with a bullish or bearish breaker near it or inside it. This entry model is very good because one, the breaker is one of the strongest PD arrays because it is the start of a new underlying direction inside of the marketplace. When we're shifting from bullish to bearish or bearish to bullish, essentially changing the structure of the marketplace, that breaker will then be the solidification of that new market structure shift. So if you guys can spot a fair value gap near or inside of that breaker, it will make that move a lot more explosive. So in this depiction here, we have this high, we created this low, then we created this higher high, and then we broke below this low. This last low here then becomes our breaker, and we've colored it in this orange box here. So this is our breaker. Now let's see if we have a fair value gap near or inside of that breaker. Well, look, we have a fair value gap right here on the daily time frame inside of this bearish breaker. So if we're anticipating a reversal inside of the marketplace and we have spotted a breaker inside of the fair value gap, I will 100% take a trade inside of that fair value gap because I understand these two paired together is going to give me the most explosive move inside of the marketplace. And this is on the daily time frame. And let's see exactly what happens. We come up into that bearish breaker fair value gap level, and then since then we've only continued to make lower and lower prices inside of the marketplace, shifting the overall structural trajectory of the marketplace from higher prices to now lower prices. And as I mentioned, that breaker is a great solidification of a new structure shift. So if you guys can get a fair value gap inside of that breaker, it's a very, very good trade idea, whether on the higher time frames or the lower time frames. Our fourth secret will be choosing the right fair value gap. When we have multiple fair value gaps in this example, we want to only be choosing the one that will yield us the highest probability. In this depiction, we have 3 fair value gaps, one at the bottom, one in the middle, and one at the top. Never choose the one at the bottom. Price tends to run right through it. What I will do is I will go in with less risk but use a bigger stop loss, put my entry inside of the second fair value gap. Since I have that bigger stop loss and the low risk, I put my stop above the highest fair value gap as an added measure of safety just in case. And as we leave that second fair value gap, I will then scale into my position and move my stop back to the high that tapped into that fair value gap. So as we can see here, we have the 3 fair value gaps, 1, 2, 3. Like I mentioned, I'd skip completely over the first one because price tends to run right through it. Instead, put my Fibonacci at the second fair value gap, get that entry inside of that 25% level sweet spot. I'd go in with less risk but a bigger stop loss to take into account this higher fair value gap, which it could reach up into. And then eventually, as price action leaves this fair value gap level, I'll then scale in. So let's see what happens. Price then breaks above that first fair value gap, like I said, taps us into that 25% level. And then we start to see price leave that area. So as I start to see price leave this area and find rejection here at this last up close candle, I'll then scale into my position right here as we start to move lower, and I'll put my stop loss above this high that has tapped into this second fair value gap. Same take profit, but instead of having a 2-to-1 R, I now get a 3-to-1 R. And let's see what happens. Price then eventually reaches down into my targeting. Trading is all about adaptation, and your stop loss is your best friend. You cannot leave the same stop loss for every single trade. You have to be aware of where you can be the safest and put your stop loss in an area and price action where you know you'll be wrong, not monetary. So sometimes you may have a smaller stop loss, sometimes a much wider stop loss, and have to scale into the full position. You have to be willing to be adaptable as a trader. So that's going to be it for the video. I hope you guys learned a lot from this video. If you guys want another part or more videos like this, make sure you guys comment that, like, subscribe. It shows me that you guys really mess with the content and really want more from me. I'm going to keep producing. I'm Arkham. Be safe. I have released my private mentorship where I give daily lessons on technical analysis, fundamental analysis, psychology, risk management, as well as live trading and much more for your trading success. If that's something you guys wish to check out and want even more content and gems from me, not shared anywhere else, it will be the first link in the description or the first link in my Instagram bio if you wish to follow me on there as well, at Arkhamtrades. Thank you for watching.